Something extraordinary is happening in the gold market right now. And I'm not talking about the price. I'm talking about the physical metal itself. Because while everyone's watching the charts, a crisis is unfolding behind the scenes that most investors have no idea about. Let me show you what I mean. Right now, if you walk into a major bullion dealer and try to order significant quantities of physical gold, you're looking at delivery times that have stretched from days to weeks, and in some cases, months. That's not normal. That's never been normal, and it's getting worse. But here's where it gets really interesting. This isn't just happening at your local coin shop. This is happening at the institutional level. At the COMEX, the world's largest gold futures exchange, something unprecedented is occurring. Historically, less than 1% of futures contracts result in actual physical delivery. Think about that. The gold market has operated for decades on the assumption that almost nobody actually wants the metal. They just want exposure to the price. That assumption just shattered. In recent months, we've seen delivery requests spike to levels that would have been unthinkable just a few years ago. Some months are seeing delivery rates that are multiples of the historical average. And this isn't retail investors, this is institutions, this is the smart money, the whales. And they're not asking for paper promises anymore. They want the actual metal in their vaults. Now you might be thinking, okay, so what? Demand is up. Isn't that just bullish for gold? And yes, it is. But you're missing the bigger picture, because this isn't just about demand. This is about trust, or more accurately, the loss of it. Let me explain how the gold market actually works, because most people don't understand this. The price you see quoted, the price that moves up and down on your screen, that's not really the price of physical gold. That's the price of paper gold. Futures contracts, ETFs derivatives. It's a massive paper market built on top of a relatively small physical market. And for decades that worked fine, because everyone trusted that if they really wanted to, they could convert their paper into metal. But what happens when that trust breaks? What happens when the institutions holding those paper contracts start to wonder, wait a minute, is there actually enough physical gold to back all these claims? That's when you get what we're seeing now. A rush for the exits. Except the exit is a very narrow door, and everyone's trying to get through it at once. And here's the thing that should terrify anyone paying attention. The COMEX has about 300 million ounces of gold in its registered vaults. That sounds like a lot. Until you realize that the open interest, the total number of contracts outstanding, represents claims on over 500 million ounces. Do the math. There's not enough gold to satisfy everyone if they all showed up asking for delivery. Now, the system is designed to handle this. It's designed on the assumption that not everyone will show up. Just like a bank doesn't keep enough cash on hand to pay out every depositor at once. It's fractional reserve applied to gold. And it works great until it doesn't. We've seen this movie before. In fact, we've seen it multiple times throughout history. Let me take you back to 1971. The Bretton Woods system. Foreign governments holding dollars could exchange them for gold at the U.S. Treasury at a fixed rate of $35 per ounce. It was the foundation of the global monetary system. Until one day, President Nixon looked at the vaults, looked at the claims, and realized the math didn't work anymore. So he closed the gold window. Just like that. No more convertibility. And the price of gold went from $35 to over $800 within a decade. Or look at the London gold pool in the 1960s. Central banks tried to suppress the gold price by selling into the market. They had plenty of gold. They had the power. They had the coordination. And they failed. The market overwhelmed them. The physical demand was too strong. And when they finally gave up, gold exploded higher. The pattern is always the same. A paper market gets too far ahead of the physical reality. Trust begins to crack. Smart money moves first. Then everyone else figures it out. And by the time the general public understands what's happening, the price has already made its major move. So where are we in that cycle right now? Well, let's look at who's buying. Central banks just had their highest year of gold purchases on record. Not just high. Record. The People's Bank of China has been adding to reserves month after month. Poland, Singapore, India, Turkey. These aren't small players, these are sovereign nations. And they're not buying paper gold. They're buying physical bars and moving them into their vaults. Why? What do they know that the average investor doesn't? Well, think about what central banks do. They manage currency risk. They manage systemic risk. They think in decades, not quarters. And right now, they're voting with their reserves. They're voting for physical gold over paper currencies, over bonds, over the very system they're supposed to be managing. And it's not just central banks. Look at what's happening in the ETF market. For years, gold ETFs were the easy way to get exposure. You didn't have to worry about storage, security, insurance. Just buy shares and you're done. But now we're seeing something interesting. The premium on physical gold over ETF shares is widening. In some cases, you can buy gold through an ETF at a discount to the spot price. That's backwards. That tells you the market is starting to value physical possession over paper claims. Quick aside here, because this is relevant. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties, because a lot of people don't realize you can actually hold physical metal in an IRA structure. Worth checking out if that's relevant to your situation. Anyway, back to what's driving this shortage. Because it's not just one thing, it's a perfect storm of factors all converging at once. First, you've got the supply side. Gold mining production has been essentially flat for years. We're not discovering major new deposits like we used to. The easy gold has been found. What's left is deeper, lower grade, more expensive to extract, and it takes 7 to 10 years to bring a new mine online. So even if gold prices spike, supply can't respond quickly. Then you've got industrial demand. Everyone focuses on investment demand, but industrial use of gold is quietly growing. Electronics, medical devices, aerospace. These are non-discretionary uses. They need the gold regardless of price. And as technology advances, as we build more sophisticated electronics, that demand only increases. But the real story is what's happening geopolitically. We're watching the global monetary system fracture in real time. The BRICS nations are openly discussing alternatives to the dollar. They're settling trade in local currencies. They're building payment systems that bypass SWIFT. And at the center of all these discussions is gold. Because gold is the one asset that every nation accepts. It has no counterparty risk. It can't be sanctioned. It can't be frozen. It can't be printed. Think about what happened when Russian reserves were frozen. Hundreds of billions of dollars, just locked up overnight. Every central bank in the world saw that and thought, that could be us. What's our backup plan? And the answer, increasingly, is physical gold in domestic vaults. This is why we're seeing gold repatriation movements. Countries that stored their gold in London or New York are bringing it home. Germany repatriated hundreds of tons. The Netherlands did the same. Austria, Belgium, others are following. They want their gold in their own vaults, under their own control. That's not a vote of confidence in the system. Now let's talk about what this means for price. Because a shortage doesn't just mean higher prices, it means a fundamental repricing of the entire market structure. When you have more claims on gold than actual gold exists, and people start demanding physical delivery, one of two things happens. Either the price rises until demand falls, or the paper market breaks. We're already seeing signs of stress. The spread between paper gold and physical gold is widening. Lease rates, the cost to borrow gold, have spiked to levels we haven't seen in years. That tells you there's a scramble for physical metal in the wholesale market. Banks and institutions that need to deliver gold are having to pay up to get it. And here's what most people don't understand about gold lease rates. When they spike, it means someone is desperate for physical gold right now. They're willing to pay a premium to borrow it, deliver it, and worry about getting it back later. That's not normal market behavior. That's stress. That's shortage. Look at what happened in the silver market back in 21. The Reddit crowd tried to squeeze silver. They bought physical. They bought futures. And for a brief moment, the market seized up. Premiums exploded. Delivery times stretched out. Dealers ran out of inventory. Now imagine that, but with institutional players instead of retail, and with gold instead of silver. That's what we're potentially looking at. But there's another angle here that nobody's talking about. The derivative market. Because the paper gold market isn't just futures contracts. It's options on futures. It's swaps. It's structured products. It's a massive web of interconnected bets, all built on the assumption that physical gold will always be available at something close to the paper price. What happens when that assumption breaks? What happens when a major institution can't deliver on a contract because they can't source the physical metal? That's a default. And in the derivatives market, defaults cascade. One failure triggers margin calls. Margin calls trigger forced liquidations. Forced liquidations trigger more failures. It's a chain reaction. We saw this in 2008 with mortgage-backed securities. The underlying asset, houses, didn't disappear. But the paper market built on top of them collapsed because nobody trusted the valuations anymore. Nobody knew who was holding the risk. And when trust evaporates, markets freeze. Could that happen in gold? Well, consider this. The Bank for International Settlements estimates the notional value of gold derivatives at over $600 billion. That's not the amount of gold. That's the amount of bets on gold. And all of those bets assume a functioning, liquid market where paper and physical trade at roughly the same price. If that breaks, if we get a situation where you can't convert paper to physical at the quoted price, those derivatives become very difficult to value. And when you can't value something, you can't trade it. And when you can't trade it, you can't hedge your risk. That's when things get dangerous. Now, I'm not saying this is definitely going to happen. I'm saying the conditions are in place for it to happen. And the smart money is clearly positioning for that possibility. Because that's what this delivery demand is really about. It's not about making a bet on higher gold prices. It's about getting out of the paper system entirely before something breaks. Let me give you a historical parallel. In 1980, gold hit $850 an ounce. Adjusted for inflation, that's over $3,000 in today's money. And what drove that move? It wasn't just inflation. It was a loss of confidence in the monetary system. It was the Soviet invasion of Afghanistan. It was the Iranian hostage crisis. It was a sense that the world was becoming unstable and unpredictable. Sound familiar? Because right now, we've got inflation that's been persistently higher than central banks want. We've got wars in Ukraine and the Middle East. We've got a fragmenting global order. We've got debt levels that are completely unsustainable. And we've got central banks that have lost credibility because they printed trillions of dollars and told us it wouldn't cause inflation, and then it did. In that environment, gold isn't just an investment. It's insurance. It's a hedge against the system itself. And when institutions start buying insurance in size, it tells you they're worried about something big. But here's what makes this situation different from 1980. Back then, gold was coming off a long period of being suppressed under Bretton Woods. It was repricing from an artificially low level. Today, gold has been in a bull market for over 2 decades. It's already at all-time highs in nominal terms. So for it to go significantly higher from here, you need a really compelling reason. And that reason is the shortage. Because price is just supply and demand. If demand is overwhelming supply, price has to rise until it doesn't anymore. And right now we're seeing demand that can't be satisfied at current prices. Not just investment demand, physical demand, delivery demand, the kind of demand that can't be turned off with a rate hike or a margin increase. Think about what that means. Central banks can't print more gold. Miners can't ramp up production overnight. The supply is what it is. So if institutions keep demanding physical delivery, if this trend continues, the only variable that can adjust is price. It has to go higher. There's no other way to balance the market. And here's the kicker. The higher the price goes, the more people will want to convert their paper gold into physical. Because if you're holding an ETF or a futures contract and you're watching premiums on physical gold spike, you're going to start wondering if your paper claim is really worth what you think it is. So you'll try to convert, which adds to the delivery pressure, which pushes the price higher, which makes more people want to convert. It's a feedback loop. This is what a short squeeze looks like in the gold market. Except it's not shorts getting squeezed. It's the entire paper market structure. And the shorts in this case are anyone who sold a claim on gold they don't actually have. That's a lot of institutions. That's a lot of exposure. Now let's talk about what this means for you. Because if you're watching this, you're probably wondering, should I be buying gold right now? And the answer depends on what you're trying to accomplish. If you're looking to make a quick trade, to catch a move and flip it for profit, I can't help you with timing. Nobody can. Markets can stay irrational longer than you can stay solvent, as the saying goes. But if you're thinking about this as a long-term position, as a strategic allocation, then the case is pretty compelling. Because here's what we know. We know that central banks are buying. We know that physical demand is overwhelming supply. We know that the paper market is showing signs of stress. We know that geopolitical tensions are rising. We know that debt levels are unsustainable. We know that trust in the monetary system is eroding. Any one of those factors would be bullish for gold. All of them together? That's a setup for a major move. And the thing about major moves in gold is they tend to happen fast. Gold can sit there doing nothing for years, and then suddenly it's up 30, 40, 50% in a matter of months. That's how it moved in 2008. That's how it moved in 2011. That's how it moved in 2020. And each time, the move was driven by a crisis, a loss of confidence. A moment when people suddenly realized that the system they trusted wasn't as stable as they thought. We might be approaching one of those moments now. But here's what you need to understand. If this shortage continues, if we get to a point where the paper market actually breaks, where there's a disconnect between paper gold and physical gold. You don't want to be holding paper. You want to be holding metal. Because in that scenario, paper claims might not be honored at the price you expect. There might be cash settlement instead of physical delivery. There might be force majeure clauses invoked. There might be all kinds of legal gymnastics to avoid actually delivering the gold. That's not speculation. That's what happened in the nickel market on the London Metal Exchange recently. Prices spiked, some participants couldn't deliver, and the exchange literally canceled trades, just unwound them. Imagine that happening in gold. Imagine you're holding a futures contract, the price spikes, and the exchange says, sorry, we're settling this in cash at a price we determine. That's the risk of paper gold in a shortage scenario. So if you're going to own gold, own physical, own coins, own bars, own something you can hold in your hand, or own it in a structure where you have allocated, segregated storage, where your gold is your gold, not a claim on a pool of gold. Because in a crisis, that distinction matters. And look, I know physical gold is less convenient. You've got to worry about storage, security, insurance. It's not as liquid as an ETF. You can't sell it with a click, but that's the point. That friction, that inconvenience, that's what makes it real. That's what makes it yours. And in a world where everything else is just digits on a screen, just promises and claims and IOUs, having something real has value. This is why wealthy families have held gold for generations. Not because they're trying to get rich. They're already rich. They hold gold because it's the ultimate form of wealth preservation. It's survived every currency collapse, every empire's fall, every financial crisis in human history. And it will survive whatever comes next. Now, I want to be clear about something. I'm not saying the financial system is going to collapse tomorrow. I'm not saying we're heading into some apocalyptic scenario. What I'm saying is that the system is under stress. The cracks are showing. And gold is the market's way of pricing in that stress. When you see central banks buying at record levels, that's not a conspiracy theory. That's public data. When you see delivery demand spiking at the COMEX, that's not speculation. That's reported by the exchange. When you see premiums on physical gold widening, that's not fear-mongering. That's market pricing. All of these things are telling you the same story. The smart money is moving. They're moving out of paper and into physical. They're moving out of the system and into hard assets. And they're doing it quietly, without fanfare, because that's how institutional money moves. They don't announce their positions. They just accumulate. And by the time the general public figures out what's happening, by the time it's on the front page of every newspaper, the move is already over. The price is already adjusted. The opportunity has already passed. That's how markets work. The information is always there, but most people don't see it until it's too late. So the question is, are you going to wait until it's obvious? Until everyone's talking about the gold shortage? Until premiums are so high that physical gold is trading at a massive premium to paper? Or are you going to position yourself now, while the market is still relatively calm, while you can still get physical metal at reasonable prices? Because make no mistake, if this shortage continues, if we get to a point where the paper market breaks, physical gold is going to become very difficult to obtain. Dealers will run out of inventory, mints will have months-long backlogs, premiums will explode, and at that point, the price on your screen won't matter, because you won't be able to buy at that price anyway. This is what happened in 2008 during the financial crisis. Gold was trading at $700 on the screen, but try buying a coin. Dealers were sold out. Premiums were 30, 40, 50% over spot. The paper price and the physical price completely disconnected, and if you didn't already own gold, you were out of luck. We could be heading into a similar situation now. Except this time, it's not just a financial crisis. It's a monetary crisis. It's a crisis of confidence in the entire system, and that's a much bigger deal. So here's what I want you to take away from this. The gold shortage is real. It's happening at the institutional level. It's driven by a loss of trust in the paper market, and it has the potential to cause a major repricing of gold, both in absolute terms and relative to paper claims. If you're thinking about gold as part of your portfolio, now is the time to act. Not because I'm trying to create urgency, but because the market itself is creating urgency. The delivery demands, the central bank buying, the widening premiums, these are all signs that something significant is happening. And in markets, when something significant is happening, you want to be positioned ahead of it, not chasing it after the fact. Because by the time everyone else figures it out, the easy money has already been made. This is one of those moments where the market is giving you information. It's telling you that the smart money is moving. It's telling you that the system is under stress. It's telling you that physical gold is becoming more valuable relative to paper gold. The question is, are you listening?